Ryan, today let's talk about a pretty timely topic. It's building resilient portfolios in a volatile world. This definitely strikes or seems to be a time when it's very hard to predict what's going to happen next. It's like we've been waiting for the recession that's never come. There's still COVID sort of lingering, but not. There's still work from home trends that are fading. Companies are still actively calling people back to work. The office market seems to be stabilizing a little bit, but at the same time, half of LA is on fire. We're entering a new presidency in 2 days. There's a lot going on. How do we build a resilient portfolio in a world where you don't know where the next punch is coming from or the next opportunity?
Yeah, I was just reading recently one economist speaking about how he's quite certain that inflation will start kicking in again because of the money supply, and we have this kind of oversupply of money, and so therefore that makes the dollar weaker, makes inflation kick in. And then on the other side, I heard someone talking about how we're heading towards a recessionary environment. And
I just listened to an investor in the stock market who's pretty bearish, saying that stocks are way overvalued and we're heading towards deflation. And it was like, and he made a compelling case, and it was like, okay,
yeah.
Part of the point is, how do you build a resilient portfolio when it's
regardless?
It could be any of these, and it will be. It will be any of these.
Yeah, and it'll be the thing that we least expect. So what are some of the key attributes of building a resilient portfolio?
I think the first thing you have to ask is, what does the customer need? Like, people need a place to live. They need to be able to afford the place where they're living.
So high demand.
Businesses need warehousing and distribution. Last mile distribution is a thing. Creating things is still a thing. The point is, the two things we do, multi-tenant warehouse or industrial parks and apartments, are long-term core demand sorts of things. So we start with, okay, we have that base. And the question is, well, how do you get a great return on those? How do you buy those in the right way? How do you spread that across geography, across quality types, and sort of hold periods to have a great outcome? Because it's one thing to have a resilient portfolio.
Yeah.
It's another thing to deliver an excellent return.
Yeah. And looking back at our history and some of our experience, part of the investing changes or movements that we've made over time have been in reaction to creating a more resilient portfolio. And I think of the move toward exclusively multi-tenant industrial and apartments when originally we were investing across retail, office, you name it. Part of that was this idea of having a more resilient portfolio. We find safety in multi-tenancy. Multi-tenancy brings stability that having large blocks of tenants doesn't bring. And so I think for us, one of the ways that we bring resiliency into the portfolio is having a diversity of tenants, a diversity of properties, but even at the asset level, having many tenants with leases that are rolling over at different times.
Well, speaking to that, we're looking for enduring demand drivers, and we're looking for things that are core and going to be there for the long term. We're also looking for a stable balance of growth-oriented assets and more cash-flowing assets. Like, if you have a stable asset, it may cash flow great, but you might not get the return you need because it's giving you safety instead of return. And then you may have growth-oriented assets that don't offer the cash flow, but have a real value-add strategy to them. Rents are at this point.
Yeah.
You could get them to this point. The right thing to do is to sort of, when you can, get both growth and stability, and secondarily to mix extreme growth with extreme stability.
Yeah.
So you're building out all those sorts of things so that they come together to build the portfolio you want, and you're building them. So that's the what, but the where is the geography, and you're looking for economies that have demand drivers behind them. You have job growth or
GDP growth.
GDP growth. On the one hand, they might be great places to live. On the other hand, they might be affordable places to live. So different areas attract different people for different reasons. But we tend to invest, or we are along the three main corridors, I-5, I-15, and I-25.
Yeah.
But we focus along these interstates where demand flows easily and more fluidly across geographies.
Yeah, and kind of going a little bit back to cash flow versus growth or appreciation, part of that resiliency or part of how that creates resiliency in the portfolio is you have that cash base, the return, the cash flow base that brings early return. And then you also have the ability to take advantage of market. As the market moves, you have that ability to take advantage of the upside. So it creates a little bit more resilience there.
Yeah.
Maybe speak a little bit to how a cost basis or how we purchase and how that brings more resiliency to the portfolio.
Well, half the battle is picking the right thing, but you can't have the right thing unless you buy it right. Mm-hmm. And there's the old saying that you make your money going in, and that is a resilient maxim of real estate investing, is that it takes a lot of execution to cure buying it wrong. Yep. And usually you can't out execute your poor decision going in. So there's a tremendous amount of effort that goes into working across a broad geography, across hundreds of sellers, across dozens of brokers to find the right assets at the right time with sellers who have gone through some level of distress or stages of grief or personal decision making to get to a price that makes sense. Every seller starts by thinking their property's worth a fortune, and over time has to meet the market, or in our case, we try to be 5 or 10% better than the market.
So how does buying right make a more resilient portfolio? How does it help when there's volatility in the market? Why is buying right so important?
Well, I mean, a company can go to zero in value, but it's hard for a building to go to zero. Yeah. It's a physical thing. It exists there. So buying it right means that you're in a safer position against new product or competitors. Ideally, you're buying a good asset at a fair price versus a new asset. This is replacement cost that's at a very high price, because a new asset at a very high price can only do one thing, and that's require very high rent.
Yeah.
But if you can buy it right in the middle, better asset than you deserve at a fair price, you're set to weather the storms in a better way. It comes down to leverage, of course, too, and maybe you can talk about that.
Yeah, and it's funny you mentioned that real estate, generally speaking, can't go to zero in value. But equity in real estate can go to zero in value, right? If you're at 80% leverage and the market declines 20%, your value has essentially gone to zero, your equity value. And that's where debt plays such an important role in creating a resilient portfolio. And we learned through living through the GFC that bad debt makes good borrowers make bad decisions. You've heard me say that before. But it's so true, and debt being more conservative in debt brings substantial resiliency to the portfolio, because two things. Number one is when you're operating at a lower leverage, you've got more margin of safety. If the market declines 20% and I'm at 50% loan to value, I've seen my equity go down significantly, but not the same as if I'm at 80% leverage. Yeah. Another way that you can bring resilience in debt is by being more conservative in the terms that you use. We saw recently that floating rate debt ended up creating some real problems because we went through this substantial rate hike period, and all of a sudden all these borrowers that had floating rate debt saw their debt costs go up substantially. One of the things that we always prefer is fixed rate debt, and we're willing to pay more and actually see a lower return to be able to have fixed rate debt, because it creates that resilience or that stability that allows us to weather through changes in interest rates and market cycles. And speaking of that, how do we build resiliency in a downturn or in an economic recession?
I mean, the first part is build a resilient portfolio, and with our two products, value add, multifamily, and industrial parks. This is like, in real estate, this is about as recession resistant as you get. Many of these leases on the industrial side are 3-year leases, and on the apartment side are 1-year leases. Like, they're turning over regularly, and it allows for resets both up and down, and allows more flexibility. But I'd say also what's interesting in downturns, those can be favorable because oftentimes the Fed lowers rates and debt becomes more affordable. Sellers are more motivated to sell properties. I mean, we're talking about building a resilient portfolio, and a portfolio has many pieces. And yes, your goal is not to buy at the top and have those pieces. Your goal is to buy in the middle and also have some pieces that you bought extreme value, and those buoy the rest of the portfolio. So I haven't found that recessions have been the biggest problem for us. Usually they bring more opportunity than they bring challenges.
Yeah.
And when you're buying across the market cycle, sometimes other parts of the portfolio support, weaker parts, and the waves support each other. It's very difficult to have one or two assets stand alone. It's important for them to be in groups. That's why we're in a series of funds. Yeah. And it's helpful to see it in that way.
Yeah, and I would also say an important aspect for us, at least, of building a resilient portfolio is control.
Yeah.
And our ability to actually execute on the property. So as market cycles change, as downturns occur, our ability to actually be boots on the ground and affecting the outcome of that individual asset brings a level of resilience that owners who are absentee or who have other parties manage their assets don't have the ability to respond to the changes in the market and the volatility.
I'd say experience is the force multiplier here. Like 20 years into our careers, we've seen a lot of things, most things, maybe not everything, but we've sure seen a lot of things. And when it comes to a portfolio issue or a building issue or a psychology issue, a fear or greed situation, like we're pretty good at spotting those things, developing defenses or attack strategies. And at this point, I find us as much setting strategy as in coaching our teams and helping groups of people or people we're mentoring within the company to attack a strategy and to see a problem and solve it. And I think the resilience comes in having a broad team with lots of different experience and having that team both having been through a lot and knowing how to handle things, but also being open-minded and sort of, I guess I want to say young enough that we have the energy to go tackle these problems and to face into them, even when they're difficult, even when they're painful. Pick a business that doesn't have pain, that it doesn't exist. So that, like, when that stuff arises, we've built the fortitude to lean into that and to solve that.
So you're saying that we're going to be entering a recession, or you're saying we're going to be entering a economic growth phase?
Of course we're entering a recession. The reason we're probably going to enter a recession is nobody says we're going to enter a recession. Like Jamie Dimon was just saying, hey, we probably made it through the difficult part and it's going to be moderate growth from here. So that probably means it's not going to be that. And
the occurrence of the word soft landing in the last 2 years has been unbelievable.
Whatever you think is going to happen, it's usually the opposite. So we have to have both an idea of, it's probably going to be sort of steady, moderate growth from here. That's probably a helpful idea.
But we're comfortable with a less positive outcome, too.
Comfort is relative. We'll take it.